In this video, I'm going to show you how to play some Jedi mind tricks on yourself to help prevent you from doing really dumb things with your money invested in the stock market when things get really, really bad. This is the way. No. This is the way. That sweet, sweet smell of the stock market nosediving faster than a 21-year-old on their 21st birthday. Or me a couple of weekends ago when I went out with my friends. I have this bump on my head for a reason. Awkward. So what goes through your mind when your portfolio is in the red? Do you jump for joy or do you question every decision that you've made up until this point? Now, if you're a normal person and not a robot, then you probably start to question all of your past decisions. Let's think about this logically. Now, I know that's banned on the internet and the investing space nowadays, but let's give it the old college try. Why do you invest money in the first place? Stupid question, I know. It's of course to make money. So when the stock market declines and we start to see our portfolios decrease, it immediately breaks our brain.
What do you mean? I have $100.
Not anymore, you don't. Poof.
This isn't how it's supposed to happen. Stocks are only supposed to go up, so when I put money in, that's what I expect to happen. Newsflash, this isn't your savings account. If you want a risk-free rate of return, then you should shove all of your money into a savings account where you earn 0.5% interest. You're not going to get rich, and you'll definitely lose purchasing power due to inflation, but at least the balance on paper isn't going to decrease. This is not the way if you're trying to create true wealth. To make money investing, you're going to have to accept some level of risk, which means that when you put money into the stock market, it has the potential to lose value, especially in the short term.
And it's gone.
What's all gone?
The money in your account. It didn't do too well. It's gone.
What you invest in and your portfolio allocation will determine the level of risk that you're going to take on as well. If you put 100% of your money into one stock, then your risk level is extremely high. If that bet paid off, then you'd be handsomely rewarded with outsized returns. Tesla is a great example. If all you had was $10,000 to invest and you put it all into Tesla back in 2011, then you would have turned that into a little over $1.7 million. But if you instead had invested that same $10,000 into General Electric stock because you really believed in the turnaround of that company, then over the same time period, it would have turned into, wait for it, $8,800. The same input in both scenarios, $10,000, and you really believed in the growth of both those companies, but two completely different outcomes. You can think of risk in the stock market like a knob that can be adjusted. Turn the dial up to 90% and the upside could be huge, but the downside could also be just as huge, except not in the direction that you'd like, of course. The more stocks that you add to your portfolio among different sectors and company sizes, the more diversified you become, which is going to reduce your overall risk. This is one of the reasons I'm a big fan of investing in something like a total US stock market ETF. With something like a VTI, you're investing in over 4,000 stocks to spread out your risk. No, the potential return isn't going to be as high as if you bet on a couple individual stocks. But if the stock market does crash, then it most likely won't go down as much as an individual stock would. Adjusting your time frame is an easy way to prevent yourself from losing money by selling when your stocks are down. Keep in mind that losing money on paper is completely different from actually losing money when you sell while the market is down. I know it feels real because you're seeing a loss of tens of thousands of dollars, but it's basically just monopoly money until you sell. If you're enjoying this video, please do my dog Molly a huge favor and hit that thumbs up button. The more likes I get on these videos, the more hikes that I can take her on, and she loves hiking. When the market is tanking, the motto I find helpful is when in doubt, zoom out. This motto isn't helpful for someone investing in individual stocks though, so I want to be very clear about that. Stock picking is a whole nother animal, and sometimes you just made a poor choice investing in that stock. When you realize that, it might make sense to cut your losses and move on. What I'm specifically referring to in regards to zooming out is the overall market in general. For the boomer passive index fund investors out there like me, we can look at something like the S&P 500 and take note of what is happening in the short term. Then we can zoom out a little more, and then zoom out a little more, then even more, until we're reminded that although the market might be tanking in the short term, as long as publicly traded companies are continually trying to grow, improve, and make money, our investments should continue to increase over time. But to truly benefit from the rise in the stock market over time, you need to be able to hang on really, really tight, even when things get very, very ugly out there. My boy Jack Bogle, the founder of Vanguard, said it best.
The rule for most things in life is don't just stand there, do something. But in these kind of circumstances, and for the long-term investor, the rule should be Don't do something, just stand there.
This is way easier said than done, so don't get the idea that I'm trying to pretend like it's easy to stand there while a 6,000-ton train is coming straight for you. I have a tip on how to hold steady, which I'll talk about in just a minute. The rule of don't just do something, stand there, even applies to when times are good and you see people around you making money off of very speculative investments. The natural thought is that if they're making money that way, then you can too. So you should sell some of those safe index funds or veer from your investing process to buy those spec stocks to hopefully make a quick buck. Next thing you know, you've incorrectly timed things and now you've lost tens of thousands of dollars when the market has a downturn. I can name 4 people who I've talked to over the past 2 months who did this and ended up losing around a combined $115,000. All thanks to stock picking YouTube channels. They make it look so easy. Thanks guys, you sure are doing God's work for the average investor out there. Looking back, these people made very dumb decisions, but at the time, each of those 4 people thought that what they were doing was very rational. Stop acting like a 5-year-old that just wants to touch every button, flip every switch, and turn every knob they see. Don't just do something, stand there. The stock market goes down even when it goes up. Over the 40-year period of 1980 to 2020, the S&P 500 saw a double-digit intra-year drop 21 of those years. To put it simply, the stock market seeing a negative return at least once, most likely multiple times per year, is completely normal. If you think about it, home prices fluctuate on a day-to-day basis, but no one ever freaks out about those small price fluctuations within that asset class throughout the year. I suppose if our home prices were plastered on the front page of most news websites Monday through Friday, then we might be paying attention to it a lot more. It also helps that it's not as easy to offload a home as quickly as it is to offload a stock. Log into your brokerage account, click that little sell button, and accept those losses. This is one of the reasons that I really like investing through the M1 Finance platform as a long-term investor. They only allow you to buy and sell 1 time per day, which prevents you from panic selling in the middle of the day. I know it prevents my little irrational brain from doing extremely stupid things with my investment account. I think what freaks us out the most is when there's high volatility in the stock market within a short period of time. This is why Benjamin Graham is famous for saying that in the short run, the market is a voting machine, but in the long run, it is a weighing machine. It's like those really popular kids that we went to high school with that everyone envied in the short term. You look at them after high school and they're nowhere near as cool as they used to be because they peaked during that short period of time. I always knew those kids were losers. It just took time to play out. Paying attention to what the market is doing within a 1-year period is the fastest way to send yourself to the loony bin. Long-term investors always win out in regards to short-term volatility, and that shows in the data. For 1-year holding periods from 1973 to 2021, the S&P 500 was up 76% of the time. For 5-year holding periods, the S&P 500 was up 90% of the time. For 10-year holding periods, the S&P 500 was up 97% of the time. So even if you just shift your outlook from what's going to happen within the next 1 year out to 5 years, things will be a lot easier to accept. The stock market crashing is one of the best case scenarios for anyone in the accumulation phase of investing, but terrifying for anyone just about to retire. I know the general age of my audience, and most of you are very, very far from heading into retirement. When the market is tanking, everything is on sale, and it's a quick way to scoop up some of those stocks or index funds that you like for a lower price. Telling you to buy when the market is tanking is a lot easier said than done because there's usually a very solid, scary reason that the market is declining at a rapid rate at that point in time. A health crisis, financial crisis, or whatever, the best advice that I can give here is to stay as delusionally optimistic as possible during these strange times. Humans are pretty stupid, but we're very good at adapting, so we'll eventually figure something out to get through this. And if we don't, then society and money will be the least of our concerns, so might as well shove all of it into the market when it's down. Speaking of the stock market crashing, if you were ever freaking out about seeing your investments tank, then it might be time to review how you are investing your money. Great investing has less to do with your actions when the market is going up and more to do with how you react when the market is going down. Look, we're all freaking geniuses when the market is on the rise. No one is getting an award for buying and holding during the good times. Because of that, you're going to be better off building an investment portfolio around being able to hang on during the good and bad times versus building a portfolio for maximum returns. Investing for maximum returns comes with a cost that's very, very, very rarely talked about, especially in the YouTube space. And that's the cost of being extremely stressed out and a mental mess when your portfolio is cut in half during down markets. You cannot have the high potential upside without the high potential downside as well. That's not how this stock market thing works. There's always a cost associated with your investment choices. The higher expected return, the higher potential for failure. It's all a matter of how much risk you're willing to stomach, and it's different for everyone. Unfortunately, I don't think the majority of investors investing for high returns will be ready to see their portfolios get absolutely wrecked when the next unpredictable event happens. The perfect portfolio that can be excellent during the good and bad times is a 3-fund portfolio. You can check out that video to your left next. Make sure to hit that thumbs up button and check out the description of this video for a ton of free stocks. I'll see you in the next one, friends. Done.